Tonight, we are going to talk about a mutual fund that is in the news and the scientifically backed way that I look at mutual funds. We're going to talk about what the heck is going on with gold, and then we are going to finish up by hearing what the Einstein of Wall Street has to say. This is the Will Whiten Show. So, starting off with the mutual fund that I mentioned, and now this is called the Mullenkamp Fund. This is from an article from Forbes that wrote up a lengthy piece about them. This is a fund that's been around for many decades, and it actually had a lot of success. And it starts in the 1990s. Mullenkamp Fund's clever value investing formula made it a star among no-load mutual funds. Then the long tech bull market left it in the dust. A new generation is making a comeback, and it goes on to say that the fund assets swelled from around $200 million in the late 1990s to more than $3 billion just prior to the financial crisis, which is a huge amount of money. Pre-financial crisis, they became heavily invested in housing stocks, so you can already see where this is going. And after that, they then had 15 years following the financial crisis in which they did not beat the S&P 500. Finally, all the way up until 2023, their assets were down to about 350 million, so almost a tenth of the original size. And this article goes on to say that the original fund manager's son took over, and the fund's been doing better. And for the last 5 years, due to the skillful management of the new portfolio manager, Mullenkamp has emerged as one of the few actively managed mutual funds to beat the S&P 500 over the past 5 years. And then we'll go on with this more in a bit. But that sounds really good. And if you're reading this article and you're not generally well informed, and you see this from Forbes, you may think, wow, this fund has really turned it around. They have new management. They're doing phenomenally. They've beat the S&P on average for the last 5 years. Maybe this is something that I would consider investing in. However, I can tell you that I learned, say, 15 years ago, that this is not a guideline that I would follow in terms of investing in a mutual fund. Now, that's nothing against the managers of this fund. I don't know them. I haven't heard of them. I don't know if they're great or not at their job. But if you were to do a survey of research studies and see the ones that look at the performance of portfolio managers, it might give you pause to invest in a fund just based on a 5-year track record that has gone very well. See, the thing about financial markets is it's an industry and a field that people cannot help but attempt to study. And I think part of the reason is because there is an obscene amount of data. We're talking about financial instruments, whether it be stocks or bonds, and then the mutual funds themselves, which would be an aggregation of stocks or bonds, or take ETFs for example. And there is an insane amount of data. And so if you are someone that likes to do analysis and likes to work with large data sets and conduct large research projects, well, the financial service industry is a great place to do it because the possibilities are endless. And the studies have been done. In fact, I was taught in my undergrad degree about several studies that were done in terms of the financial markets and specifically fund manager performance. And some studies mentioned about 20 years, others determined about 40 years of a track record that would be necessary to determine whether the fund manager is making a statistically significant impact on the performance of that fund, or if it's just luck, or if they're just being buoyed by the general market. 20 to 40 years, so we'll just call it 30. And I remember particularly, it was, I think, a little over 30. Another study talked about Eugene Fama and French, I'm forgetting the other person's first name, are two well-known academics in the finance space. They've done a study on this. So let's just say 30 years. 30 years of a track record to determine if a fund manager is actually adding value to that fund, if they are actually demonstrating skill. And so then when I read a news story about a fund that did really well and then it's been off track for 15 years, but now it has new management, it's had a really great 5 years, good for them if they've turned it around. But do I know for sure if it's based on their skill? If I look at the academic papers, I don't know if it's based on their skill or just luck. If they've just happened to flip a coin 5 times in a row once a year and landed on heads 5 times in a row. It's not very likely, but it's possible. And so while I find these stories interesting, I also take them with a grain of salt. Now, if we think about how many stocks are out there that are publicly traded on the major exchanges, it's about 4,000. 4,000 companies that you can buy shares in, that you can become a part owner of. Now, between the mutual funds and ETFs that buy up these stocks, there's 8,000 mutual funds and ETFs, all trying to find the best way to buy the 4,000 stocks that we mentioned. It's not as many as you think. It was a surprising number the first time I heard it, that there's only 4,000 on the major exchanges. If I were to take a guess and not have any education in the matter, I would think there'd be 20,000, right? 20,000 stocks you could buy from. That's not the case. That's not the case in America. There's 4,000 on the major exchanges. We'll see in 25 years if this fund's turnaround efforts are successful to the degree that it's statistically significant, that it can be almost completely proven that it's skill that has returned to this fund and made it a success. And we'll see if they can become one of the funds that is successful. And that also begs the question, out of the 8,000 mutual funds and ETFs, how many of those do you think have a 30-year track record? A 30-year track record of returning more than the S&P 500. I don't know the exact number, but I'm going to hazard a guess that it is nowhere near all of them. Nowhere near any significant portion of them. In fact, very few, I'm sure, will have the same manager for 30 years, let alone have been successful for 30 years. So this is something that I keep in mind. And, so obviously, say there's nothing that fits that criteria. That doesn't mean that I wouldn't invest in mutual funds. Maybe we loosen the criteria to about 20 years, as some academic studies have suggested. But it's something that I always try and keep in mind. You can obviously handle it the way you're going to handle your money. And while I think these articles are interesting, it's not going to make me run out and invest in a fund just because they had a good 5 years. Now, continuing on, it gets interesting. The mutual fund currently has 19% of its assets under management in gold stocks. And so this is the part where we're going to talk about gold. If you've been following gold at all, this year it has had a phenomenal run. It's seen, I think on Monday, it peaked at 60% year to date. Today had a bad day. It was down 5.5%, which probably should be expected with such a phenomenal run up. But what is it about gold that interests people? It's often cited as an inflation hedge. So, right, what is inflation? We say prices are going up over time. Why are prices going up over time? One of the causes could be excess money being printed. Or we could just say money being printed. We don't have to say excess. And we saw this during COVID under 2 different administrations. Lots of money being printed, prices go up, right? Because there's more money in the system. And people have to do something with that money. And if you're buying a cup of coffee at $2, but now everyone has, and we're just going to run this to the extremes, if everyone now has double the amount of money that they had before, or there's double amount of the money, there's double the amount of money in the financial system than there was before, that money has to go somewhere. And so if you're the coffee purveyor, then you might say, well, I'll charge $4 because there's double the amount of money. Charging $2, I'm now getting half of the value that I used to because there's now twice the amount of money out circulating in the system. This isn't perfect math. This is an extreme example. Money can go all sorts of places. It can go into actually buying goods when you're a consumer, or it could be invested in financial assets. That's another thing that we saw. A lot of people invested. A lot of people saved money, but a lot of people also invested. Spending went down. Everyone's savings accounts jumped up during COVID and shortly after, and the financial markets went up. A lot of people weren't spending, but they were saving and investing. So when this is happening, this could give people concern over the value of their dollar. They say they have $100,000 in a savings account and there's rampant inflation. Well, that makes them not feel so good about their dollars. They think the value of the dollars is going down, and they're right to think that. And so they say, well, what can I do with my dollars? Some people buy stocks. Some people buy gold. And so gold has typically been thought of as the best inflation hedge. I believe there was a Wall Street Journal article several years ago that actually said oil was a better inflation hedge. I'll try and dig that up. But gold is often looked to as a place to put your money instead. So when there's concerns in the economy, or there's uneasiness, and even if it's not inflation, it could just be general concerns. If there's a trade war going on, if there's tensions with foreign countries, right? If there's unsurety, it's okay. Well, I'm afraid to leave my cash in the bank, but I'm also afraid to invest in the financial markets because, what if everything just goes to zero, which wouldn't happen unless we got hit by the moon, right? That was a famous Jamie Dimon quote. I want to say back in 2012. Rebuilding after the financial crisis, and he was asked when testifying if there is a chance that there could be a multi-trillion-dollar loss at J.P. Morgan Chase, and he said, not unless we got hit by the moon, right? A lot of people think, oh, everything can go to zero, and of course it's a non-zero chance, right? In case the moon or the big asteroid comes, but it's otherwise typically not likely. But anyway, people don't think about that, and they get scared, and they say, well, I'm going to buy gold, right? And so many people are definitely buying gold. I haven't bought gold because here's the thing with gold, and a lot of people miss this point. When you buy, and we'll back into the idea, when you buy a stock, what are you doing? You're buying a share of a company, and there's the behavioral impacts of that company. So there's the general market consensus over what everyone thinks that company is worth, and that can affect the price. Fine. But at the end of the day, there's still underlying value in that company because that company has products, they employ people. It's called enterprise value, right? It has a management team, and they're selling these products, and they have manufacturing, and they have vendor relationships, right? There's an enterprise value there. And there's a chance for that enterprise value to increase. If they're creating new product lines, if they're increasing their prices, if they're just driving more sales to their existing product lines, there's a chance for that company to become more valuable. So when you're buying a stock, there's a chance that there's actual fundamentals underlying the price of the stock that you bought. In addition to that, the company's management can decide to issue dividends. They've made a lot of money. And they're not exactly sure if they can invest all of that money back into the business, or maybe they are sure, but they also want to reward shareholders, and therefore they declare a dividend. So they give the shareholders money, excess profits. They give the excess profits to the shareholders. Or they can take that money and buy stock buy their own stock, the company's stock, off the public markets, therefore making the value of the shares that the remaining people own more valuable because there's less of them, right? So that when you're buying a stock, all of that's going on. And if you're owning a stock, you have the chance to increase your investment by the growth of the business, like I talked about, or getting dividends, or having share buybacks. Now let's pivot back to gold, and none of that's happening. Gold is a rock. It's a metal. It's a very hard metal that looks like a rock, a shiny rock. And this rock is not going to pay you dividends. If you buy a lump of gold, it will not turn into 2 lumps of gold. If you buy a lump of gold, the management of the gold is not going to issue a dividend or become more efficient at being gold and shiny, right? It is a rock. And so what drives the price of gold then? Well, what drives the price of gold could be fear in the market, right? General sentiment, which is the same for stocks. And then you have the actual supply and demand dynamics of the gold industry. Now you're talking about the miners that are extracting the gold, the people that turn the gold into more usable forms, and then you have the actual, just call it retailers that are selling jewelry made of gold, right, or whatever else gold can be used for. That's very different. That is a very different underlying, those are very different underlying fundamentals of what you are buying when you buy gold. And so you're really relying, if you buy gold, on everyone's fear to continue to increase, or the supply and demand fundamentals to significantly shift such that demand dramatically increases or supply dramatically decreases. You're not looking for the underlying enterprise value of an entity to increase through expansion and new product lines, etc., or management deciding to give you a dividend. So this is why I don't buy gold. I want dividends. I want companies that grow a lot over time, and gold doesn't do that for me. Now, this comes at the expense of me looking short-term foolish, right? Missing a 60% run-up can make me look very foolish, but that's okay. I'm comfortable with looking foolish in the short term, as long as I'm successful in the long term. So that's what's going on with gold. That's what's going on with Mullenkamp funds. Of course, nothing against Mullenkamp funds. They could be wonderful people. They could be very talented people. But from what I've seen, the academic studies would tell me that a 5-year track record is insufficient to make a buying decision. Okay, so I also promised that we were going to hear from the Einstein of Wall Street. So this is a name that's been given to a Peter Tuchman. He is a broker on the floor of the New York Stock Exchange. You've probably seen his picture if you follow the business media at all. He has Einstein hair, okay? He has long white hair that kind of shoots out both sides of his head. And so he got the name the Einstein of Wall Street. Of course, I'm sure he imparts wisdom to complement his hairstyle. And this is an article from Fortune. It says, the Einstein of Wall Street says the best way to get rich is to invest in stocks, not stuff. The article goes on to say, stop buying things. This is his advice to the new generation. And for that matter, this sounds like good advice to any generation. But stop buying things that lose value the moment you purchase them, and start investing in companies that make them. I guess now we know why he's called the Einstein of Wall Street. That's a very smart comment. And what comes to mind when I hear this is the difference between consumer and creator. And in life, I think it's important to think, am I being a consumer now, or am I being a creator? And being probably too much of one is bad, regardless of which one you pick. But I think in particular, he's trying to reach out to the people that are only consuming. And in particular, the younger generation, which we've seen reports of, are feeling extra depressed and feel like they can't get ahead and they're not making enough money and they can't buy homes and they're upset about the economy and their place in the economy. And that may lead them to say, well, I'm not going to try and create or build wealth for myself. I'm just going to consume. But that is a very short-term strategy. Being a creator, and when I say that, I refer to working at a skill and gaining money for performing that skill, trying to increase your net worth to support your family, to create financial stability for yourself so that you can take care of yourself, as opposed to just blatant consuming. And this is done by buying, as he says, the companies and not the stuff they make. Now, of course, I go back to, this doesn't mean that you shouldn't buy anything and then you're just going to live, with absolutely nothing in a bare apartment. But you don't want to overdo it with the consuming. And I think it is very likely, whether you have a family or not, but let's say you have a family, I think it is very easy to consume while thinking that you are creating. And I'll explain what I mean. If you have a family, and say you grew up either poor or middle class, but now you're doing very well, so you're making $200,000 a year. That's more than double the median income in America. So you're doing great in relation to the rest of the country at $200,000. And you say, you know what, there are so many things as a child that I didn't get to have, and I want to make sure my children have them. And that's a great sentiment. That's a great sentiment. And you do this by buying a house that is way too big and buying 2 luxury vehicles that are very expensive, trying to live in a name brand neighborhood or zip code, trying to send your kids to name brand schools, trying to dress in name brands with certain logos. You get the picture. Going to name brand destinations that you probably can't afford, even with a $200,000 income. There are plenty of travel destinations that you cannot afford on a $200,000 income. I believe that. And what are you doing? You say, I am creating a better life. And yet, I call this consuming. You are being a consumer. You are being you're heavily consuming. And it feels like you're creating, but here's why I don't think it is considered creating, and that is because your creating is 100% relying on your labor. You have to go to work and get your paycheck so that you can keep creating the life that you have for your family. But at some point, we will all stop working. And some of us will work till we die. Some of us will work till we feel we can retire. Some of us will work until there's an injury and a disability that prevents work. And that's when the music stops. The music of the lifestyle that you've quote unquote created will stop. So I do not think it is considered creating when you're creating based on just your labor, trading your time for money, because that will end. I think creating should be saved for more sustainable, not environmental, but more sustainable money management, right? We'll call it that. Instead of buying all of these things, taking that money, investing it in skills to improve yourself, to make your life better, investing it in time to foster better relationships with your family, investing it in financial assets that can grow and then pay you to be used to then consume things, right? As opposed to, I'm going to trade my time for money, I'm going to take that money, I'm going to buy a thing. Instead, I'm going to trade my time for money. I'm going to take that money. I'm going to buy an asset. That asset's going to pay me money. And at that point, I can decide if I want to buy a lot of things. Right? So I think it's important to call out the consumer versus creating. I think that Peter Tuchman gets it right. He's saying that there should be, in my interpretation, more creating and less consuming, especially among the younger generation. But I think with all generations, it's a good message. So that's the news for today. Have a good night.